Welcome back to the portfolio, everyone. And in this video, we're going over 7 stocks Jim Cramer believes might be a great buy now. These are 7 companies that will continue to grow even if there's no stimulus deal put in place, with negotiations stalling and the idea that a stimulus package won't get done anytime soon. These are companies that may be in under the radar bull markets that he believes will continue to grow. Jim Cramer is a CNBC analyst. He's the host of Mad Money and is on TV all the time on various different programs discussing the market and is known for making bold predictions. And in this article, we're going to go over 7 different stocks that he believes are in a bull market that will continue to surge. And these are all the companies that don't need a stimulus package or a stimulus deal to get done in order for their share price to continue to grow. And in this list today, he goes into a side of under the radar industries and doesn't focus on the stay at home or the high based tech stocks or the cloud stocks that are kind of like the hottest investments of 2020. These are more smaller industries that might have been overlooked over the short term that he believes will continue to grow. And he goes over 7 different industries, and in each industry he gives various stocks. So what I did was go through each individual industry, went through this entire list and picked what I believe was the top pick from each of the 7 industries, and those are the 7 stocks we're going to go over in this video. So as you may know, everyone, I am the Gen Z investor, and every single day we talk about the stock market, we go over different stocks you can buy, all stock market news and performance, and any big overall big up headlines in the market. So please hit that like button and subscribe. I want to jump right into the first stock Jim Cramer believes will continue to grow and expand even without a stimulus deal. And that company is Chipotle Mexican Grill in the restaurant industry. Ticker symbol CMG has seen their digital and mobile orders grow in massive double-digit rates throughout this pandemic. They're up 54% over the past 12 months and have a $35 billion market cap. They do not pay out a dividend. This is a growth stock. If we take a look at a quick peek at their income statement, they have overall nice revenue growth year over the past 4 or 5 years. And this company is expected to post double-digit earnings growth over the next 3 years as well. The second one is the apparel industry, and it is Nike. Nike's direct-to-consumer platform has only been surging through this pandemic. They have such high margins selling their products direct to consumer that this is a brand that he believes will continue to surpass where it is today, and with or without a stimulus deal, this company is going to grow. Currently under $131 a share, ticker symbol NKE is up 41% this year. They currently have a market cap over $200 billion, and they pay out a slight dividend yield. The current yield for Nike comes in at 0.75%. They're only paying out around 34% of their earnings in the form of a dividend, and they have a beautiful 5-year dividend growth rate of over 12% averaged over the past 5 years, and have been growing that dividend for 18 consecutive years. Their dividend safety score is 99, which is the highest score possible, representing an extremely safe dividend from this company, where we really don't have to worry about the dividend getting cut anytime soon. The third stock on our list today is ticker symbol UNP, Union Pacific, at $205 a share, currently up 34% over the past 12 months, and over a longer term perspective, over the past 5 years, up 112%, and up over 384% over the past 10 years. This is a very stable, long-term hold in a lot of investors' portfolios. Railroads aren't really getting built as much as they used to, and the existing infrastructure is in high demand, and UNP is well positioned across the country in order to continue to grow revenue. They currently have a market cap of $139 billion and are currently yielding 1.88%. They're paying out around 49% of their earnings, which is very sustainable, and have only been growing that dividend at an astounding 14% average over the past 5 years, which is incredible. And if we take a look, their dividend safety rating comes in at 88, which is once again considered very safe, a dividend that we do not really have to be worried about getting cut over the short term. Stock number 4 is PPG Industries. This is kind of an unknown stock, ticker symbol PPG, up 18% over the past 12 months. Another company where Jim Cramer is going to continue to believe that their surge is going to continue to grow, even if a stimulus deal does not get done. $32 billion market cap on this company. Over the past 5 years, they're up over 41%, and they currently yield 1.6%. An average dividend payout ratio of around 39% of their earnings, and are growing a nice job of growing the dividend at over 8% averaged over the past 5 years with a 48-year dividend growth streak. So this company is very close to hitting that 50-year mark and becoming a dividend king, which would be a great milestone. A 93 dividend safety score. This just shows that with a 48 consecutive year history of growing the dividend and still have a 93 dividend safety score, it just shows that this company can really weather any economic downturn, any pandemic, anything like that, and continue to grow earnings and dividend payments each and every year like they've been doing for 48 consecutive years. Stock number 5 is ticker symbol DE. Deere and Company, $234 a share, up 41% over the past 12 months. So these are all companies that Jim Cramer believes are kind of in under the radar bull markets right now that may continue to surge. And you can see here, since the March lows, DE has been doing just that. $73 billion market cap on this company. They are a dividend paying stock with a 1.29% current yield and paying out around 40% of their earnings in the form of a dividend, and have a nice job of been growing that dividend at a rate of over 5% average over the past 5 years with an 83 dividend safety score, which is great to see. And last year alone, they grew their dividend at a rate of 18%, which is very fast, and you can see here year over year nice growth in their dividend payment. Stock number 6 is a packaging company, ticker symbol IP, International Paper Company. Just over $42 a share and up over 8% over the past 12 months. You can see here they are actually being traded below their pre-pandemic high of around $47 a share. They were hit hard in the month of March, but have continued to slowly recover, but are not back up to pre-pandemic highs. A $16.7 billion market cap on this company with a very high dividend yield. Currently yielding 4.8%, but are paying out over 81% of their earnings in that dividend. So that is a very high payout ratio. This is on Jim Cramer's list of stocks to hold and actually buy during this time that may be in this under the radar bull market. But this one's a little interesting. So a nice high dividend yield, yes, which is of course beloved by investors, but they're paying out over 81% of their earnings. For a lot of companies, I like to cap out a payout ratio between 70 and 75%. Different industries may allow you to go higher, such as like a utility, but this is kind of on the higher side for me. And if you take a look at the dividend safety score, with a 52, it's considered borderline safe. So that of course includes the fact that they have a high payout ratio, that this dividend, maybe over the short term, is considered safe, but over a longer term perspective, if the company can't bolster up their earnings and get that dividend payout ratio a little bit lower, the dividend may be at risk. And the final and 7th stock is in the car industry, Group One Automotive, $124 a share. You can see here once again, hit very hard by the month of March, continues to slowly recover and have seen a rapid surge as of late, and they're actually up 48% over the past 12 months. The smallest market cap company on this list today at a $2.19 billion market cap, yielding less than 1% at 0.47%, a minimalist payout ratio of only 4% of their earnings, which is extremely low, and they've been growing that dividend at a rate of 9% average over the past 5 years. And although this dividend growth streak shows as 0, if we take a look at that actual streak, you can see here, year over year, they've been growing that dividend payment over the past 10 years. So these were 7 different stocks in 7 under the market, under the radar bull markets that Jim Cramer believes will continue to surge. He stayed away from all the cloud stocks or the high growth tech stocks in this list. And these are kind of less talked about industries in the market. Like we talked about a restaurant, we picked Chipotle, we went through the apparel and we went with Nike. Used cars was Group One Automotive. Packaging was International Paper. Agriculture, I went with DE. And some chemical companies, we went with PPG. And the railroads, we went with Union Pacific. So these are companies that Jim Cramer believes will continue to surge with or without a stimulus deal, with negotiations kind of stalling right now, and there kind of isn't really a clear sign on whether or not we're going to get a deal done. These are some companies in some industries of the market that he believes will continue to rise and bulls should be taking a look at. So thank you for tuning in, everyone. As you know, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy, overall stock market performance, and any other big market news and headlines. So please hit that like button and subscribe. I post every single day, and I really do appreciate everyone who leaves a comment down below. Let me know if there's any stocks you want me to take a look at, any companies you want me to examine, or any type of list type videos like we did today for stocks to keep on your watch list. So thank you for tuning in, and I will see you in tomorrow's video.